Let's look at a second scenario here. In the example given above, assume that the original cost was £15,000, revalued upward to £20,000 2 years ago, and has now fallen to £13,000. So what do we do? So second scenario, so we bring in the initial cost, and that is going to be coming up here of £15,000. Then what are we told? Revalued upward to £20,000 2 years ago. So let's go. We bring in the revalued amount 2 years ago, 20,000. So the balancing figure means we will recognize a revaluation surplus of £5,000. Then they said the value has now fallen to £13,000. So we bring in the revalued amount. Again, this is a land, so we keep it simple. So revalued amount in current year, 13,000. So the balancing figure, it's going to be the revaluation loss, 7,000. So how do we account for this? Now, so again, if you pay attention, it's just a flip side of that, of the same question solved in another, presented in another way, so you can see both parts. So let's look at the journal entry in the current year. We are having a loss of 7,000, so suddenly we are supposed to credit the land account. So we credit the land with a loss of 7,000. But what do we debit? We have to debit the revaluation surplus account with the surplus that we had 2 years ago in respect of this same asset, the land, which is 5,000. Now, since the loss is 7,000, it means we have to write everything off. So we'll debit revaluation surplus with the 5,000 because that is what is there, so that the balancing figure will be taken to the profit or loss account. So we debit profit or loss with a balancing figure, and that's going to be £2,000. This is what we are talking about. Now, there is another level of treatment that we need to understand where there is annual transfer, and I'm going to be illustrating that in a moment. But we could have an annual transfer, and that annual transfer could change the way the values will be. Now, this is land. It's not a depreciable asset, so we won't do transfer in respect of it. But if it is building or other forms of assets, then it's a depreciable asset, because one key principle that you need to also understand is that depreciation is calculated on revalued amounts. And so normally what happens is that more depreciation is going to be charged on the asset after it is revalued than we are charging. And so to compensate shareholders for that excess depreciation, we're going to be moving the money from, or the amount from, the revaluation surplus account into retained earnings. And the journal entry for that is to debit the revaluation surplus account and credit the retained earnings, which means that in subsequent periods, the revaluation surplus account will be reducing. And so it doesn't really change our double entry thing. It just tells us the amount of money that is available in the revaluation surplus accounts in subsequent years as we try to work this out. Let's look at the final scenario here. It says that Crinkle Co. bought an asset for £10,000 at the beginning of 20x6. Now, for disclaimer purposes, these set of questions are coming in from the corporate reporting and audit and assurance for the Institute of Chartered Accountants England and Wales manual. So that's where we are picking these questions from, and we have, a ton of questions here that we're going to be going through throughout in this masterclass. And so that is the source document for some of these questions that we are bringing up. Crinkle Co. It says, Crinkle Co. bought an asset for £10,000 at the beginning of 20x6. All right. So we bring in the initial cost of the asset at 1st June 20x6, £10,000. It had a useful life of 5 years. So it means we are going to be depreciating this one. On 1st January 2018, the asset was revalued to £12,000. Stay with me. So the revaluation is being done at the beginning of 2018. Remember, the year ended for us is 20x8. So it means the asset was used in 20x6, was used in 20x7, because the revaluation is being done at the beginning of 20x8. So what do? We have to calculate depreciation. So we less the depreciation for the 2 years. And that is going to be £10,000 over 5 years times 2. So this is depreciation for the 2 years because the revaluation was done at the beginning of 20x8, which is in the third year. So what do we have? 10,500, that will be 4,000. And so the carrying amount at 1st Jan 20x8 will be 6,000. The day on which they did the revaluation. Then we bring in the revalued amount. So revalued amount 1st Jan 20x8. We are told it was revalued to £12,000. So what do we have? The balancing figure, it's going to be a revaluation surplus, which is £6,000. So in the current year ended revaluation surplus, this is the first time, and that will go to OCI as well, other comprehensive income. But let's see. What else did he say? The expected useful life has remained unchanged, i.e. 3 years remain. Because if the useful life is 5 years, right? And we've done 2 years, that means we are left with what? 3 more years to go. So now, depreciation for the current year ended, which is 31st December 20x8, will be calculated on the revalued amount. So we bring that in, we less depreciation for the year, and that's going to be the 12,000 over the remaining economic useful life, 3 years, and that's going to give us an amount of 4,000. And so we get £8,000 as the carrying amount at the end of the year. Now, so I'm going to do 2 things. One, I'm going to do the default thing, assuming there is no annual transfer. How would the treatment look like, right? Then we'll look at a transfer. How would the treatment also be like? So, Crinkle Co. Statement of profit or loss and other comprehensive income for the year ended 31st December 20x8. We're slashing our currency sign. Please, professional presentation is very, very important. So in the profit or loss, what comes there is the depreciation for the year, which is the £4,000. Now, you got to be careful because you don't bring the total depreciation from the time we bought the asset. No. This is another thing that students screw up with. We bring depreciation relating to the current year ended under review. That's what we are interested in. Because the last 2 years depreciation, those have been accounted for already. So we have no problem. Sounds good? So we are going to bring just the depreciation for the current year. Then we go to the OCI, other comprehensive income. So in the other comprehensive income, we bring in the revaluation surplus. Because the revaluation was done at the beginning of the current year, we bring the revaluation surplus here. And that is going to give us an amount of whatever the heck, £6,000. And that's it. So that is the extract. Now, this is an extract. So again, we want to let the examiner know that we know what the heck we are doing. So we put extract in brackets. So that's our statement of profit or loss and other comprehensive income. What comes in the position? Pretty simple. So statement of financial position as at 31st 12 20x8. Also an extract. Is boring, but you got to write them down. So what do we have? We're going to bring in the non-current assets and the carrying amount, which is the 8,000. That's what's going to come here. Then we go to equity, and in equity, we're going to bring in the revaluation surplus. And that is going to be how much? Okay, it's even up there, 6,000. So this is the answer to the question. Again, in this one, we are assuming that the entity doesn't make transfers. So the question then we have to ask ourselves is, okay, how would we present this if the company makes a transfer? Because again, if you remember, I said something that depreciation is calculated on the revalued amount. So when we calculate depreciation on the revalued amount, it means you are charging more depreciation than you're supposed to have charged. So if you follow what is happening here, you realize that in the top here, the depreciation for the 2 years was 4,000. because each year we charge a depreciation of what? 2,000. But after the revaluation, the depreciation for 1 year was 4,000. Now, depreciation is an expense, and so what it means is that the profit is going to reduce. It means shareholders will not have a lot of amounts payable to them as dividend. And so sometimes an entity may elect to transfer the excess depreciation arising from the revaluation surplus from the revaluation surplus account to the retained earnings. Now, our P&L and OCI will still remain the same as it is supposed to be. But what is going to be happening is the carrying amount of the revaluation surplus at the reporting date. The carrying amount. And so I'm going to just duplicate the position to bring in the annual transfers. So assuming the entity is doing a transfer to compensate the shareholders. So transfer from revaluation surplus to retained earnings. All you would do is that to be able to get the annual transfer, you can just take the revaluation surplus figure divided by the remaining economic useful life of the asset. And so if we take that, what was the revaluation surplus we had? We had a surplus of 6,000. The remaining economic useful life was 3 years. And so every year we would transfer £2,000. And the double entry for that is to debit the revaluation surplus accounts and credit retained earnings with the £2,000. So if I come to my position, because we are doing a transfer of 2,000, right? In the position, the revaluation surplus will no longer be 6,000. It will be the 6,000 minus the transfer of 2,000 we are making. So now the carrying amount is going to be 4,000. Then we did a transfer to the retained earnings, so we can bring in the retained earnings, 2,000. Please note, we are doing the transfer for this current year ended 31st December 20X8 because the revaluation was done at the beginning of the year. If they had done the revaluation at the end of the year, we won't do any transfer for that year. So we only do the transfer in the year of the revaluation if the revaluation is done at the beginning of the year or midway in the year. But if the revaluation is done at the end of the year, we won't think about any transfer issue. Why? Because if a revaluation was done at the end of the year, then you have done the calculation already in respect of the depreciation amount. So that is what we need to understand when it comes to dealing with the annual transfer. Now, this question was quiet, so you don't worry yourself to do the transfer. Does that make sense? The question was quiet. So if the question is quiet, just do your normal thing like we presented. What the heck? Like we presented like this. Take the revaluation surplus to OCI, take it there, and then you go away in that case. No problem on that. But if in the question we are told that a company makes annual transfers, then it will be looking like this. And as I said, you will just have to take the revaluation surplus divided by the remaining economic useful life. But as I said, we will only do this if the revaluation was done at the beginning of the year or within the year. If the revaluation was done at the end of the year, in the current year, no transfer will be done because you didn't calculate depreciation using the revalued amount. I'm emphasizing on this because of the principles that some people butcher. But that is the idea about that for crinkle. So in revaluations, you need to know how to recognize the following. 1, a loss. 2, a gain. 3, make transfers. And 4 is the deferred tax implication, which is where IAS 12 comes to town, income tax. And I'll come back to the deferred tax implication later on when I walk you through IAS 12, and then we are solving questions about that. We'll bring ourselves back to the IAS 16 and deal with what we have here. So that is the concept of how we deal with revaluation of assets and the way they must be treated. When there is a loss, how do we go about it? When there is a gain, how do we go about it? And most importantly, when there is a transfer also, how do we go about it? So we've touched on the first three items. The fourth one, as I said, we're going to be looking at IAS 12, solve some questions about that as well, and then bring back IAS 16 fused with IAS 12 in the deferred tax implication when assets are revalued.